Art Energy's Premium Blend Series presents exclusive interviews about the oil and gas sector with the industry's best managers and analysts.
Energy investment has been challenging, but people have money that they need to put to work, and that means that they don't really get a holiday when there's volatility in the market. They still have to figure it out and still have to figure out ways to make money and make a return for their investors. And interestingly, with the downturn, there's been I would argue, a tremendous amount of capital being earmarked for energy investments. And the story is simple. Energy will always be here. It's an important part of the global economy. And we've got a cyclical downturn. That should spell opportunity. And folks, hear those two things. It's something that will be around forever. And on the cyclical downturn, and think that they need to allocate some incremental investment capital to the space. So there's a lot of money arguably sitting on the sidelines right now, but very anxious and eager to get in. So there's more money to invest probably than it feels like there's investable opportunities today. Hopefully that changes here in the near future. Growth opportunities on a go-forward basis again are likely to be limited near term to natural gas demand opportunities where folks are taking advantage of low domestic natural gas prices. And there will be quite a few of those opportunities, but they tend to be smaller in scale. The other growth opportunity that is easy to ignore but very real is the backlog of projects that large companies and small companies have on the books, backstopped by E&Ps that are still very viable entities that will continue producing. Those projects need to get done, and they will get done. So that growth happens. And it may be a bit of a bridge here. So that growth happens over the next 3 years. Most of the projects happen in that 16, early 17 timeframe, but we're still building out a tremendous amount of pipe in the Marcellus, for example. We're still building out some processing in the Eagle Ford and the Permian. And we are still building out some long-haul oil crude pipelines to displace largely rail volumes. So all that will happen. That's real growth. It is ongoing. The incremental stuff, like I said, natural gas demand center type stuff, and then there'll be a little bit of infrastructure that we need over the next 2 or 3 years on the liquids side, again, for liquids export opportunities, particularly, again, out of the Northeast. So that all happens, and then 3 years from now, we fully expect to see a very different commodity price environment, and we'll be back to the races. Incremental projects is largely going to be demand-driven projects. And that is demand, prototypically it's demand for power gen, and LDCs, local gas distribution companies, they're looking for alternate sources of supply, particularly out of the Marcellus. That will be, it won't be the landslide of projects that we've seen in the last 5 years, but it'll be small incremental projects sourcing gas from new basins, in this case the Marcellus, for existing points of demand, and or for natural gas-fired power plants, new sources of demand as those capacity factors, those run times ramp up for those gas-fired power plants as gas becomes or continues to be more competitive than coal certain parts of the year, or new power plants. So how are MLPs adjusting to the downturn? They're in the midst of it and trying to figure it out. But there's really nothing that needs to be done. So we have a downturn. Throughput volumes, again, may decrease in some basins, may stay flat in others. The Permian's probably going to be relatively flat here. What does that mean from a company perspective? It means that you will be harder pressed to find incremental growth projects beyond your current backlog. It may mean that your cost of capital is higher because you're not growing as fast. But it's still a good deal, right? You're still building assets at a relatively low multiple, call it 8 to 10 times, and selling it to the market as a yield product at something like 15 times. That's still a very good business model. It may not be as extraordinary as we've seen with the dramatic growth over the last 5 years, but the change from extraordinary to just a good business model is not that life-threatening for the industry at all. It's still a very attractive industry.
To learn more about this topic and others, check out this month's print edition or the daily updates on this website.